In this video, I'll be covering the first section of Chapter 12. And Chapter 12 starts us into what's known as fundamental analysis. And fundamental analysis is looking at the fundamentals of whether that's a country or an industry or even down at a company level, but sort of the fundamental drivers of value or the things that could affect the investment value of a company or a market. Okay, so in Chapter 12, we're going to start top down, we're going to start high level and talk about macroeconomic fundamentals, and then we'll talk a little bit about industry analysis and some of the fundamentals and things that you would look at in an industry to try to understand which industries are going to outperform or underperform. So here's the big picture to keep in mind, all right, why you would study this. In the context of CAPM, so according to CAPM, the most significant risk is systematic risk. What is that? Market-wide risk or economy-wide risk. Okay, so it points us, CAPM points us to sort of broad economy-wide risks and economy-wide events. So in the context of financial markets, macroeconomic indicators, those are the ones that tell us about global and country level or economy-wide systematic risk. So it makes sense, even in the context of CAPM, to study that. Okay, we'll see then at a lower level, industry analysis determines the risk factors that affect entire industries. All right, so what we're going to do in these slides is we're going to provide a high-level overview of both macroeconomic and industry analysis. And in particular, this is not an economics course, we're finance and we're investments. So we're going to look at the indicators that would be most relevant to somebody who's thinking about investing. All right, just a caveat before we jump into this. These days, the economy is very global, okay? So it goes even outside of countries. So in a top-down approach, one would likely start even with the global economic environment of countries. In general, this shouldn't be neglected, right? So this could have a large effect on investment performance. However, in this chapter and in these slides, we're going to limit our attention to the domestic macroeconomy. That is just the U.S. economy. Okay, if you're interested in things beyond just the U.S. economy, then you would look at a course like international finance or international investments. We're going to start at the country level and then work our way down here. So that's just a note. All right, let's jump right into it. In this video, I'm going to cover just the first section here on the domestic macroeconomy, and that for us is the U.S. economy. All right, let's dive right into it. So we're talking about the highest level. Sort of how is the economy doing, and what are the indicators or things that people will watch to see how the economy is performing. So in general, those are macroeconomic indicators. They provide a glimpse into the current state of the economy. And we're going to look at the sort of highest level ones, sort of the top line indicators, and the ones, we're going to look at them in the context of the ones that are relevant to investments. All right, and I'm going to run through the following 6. So GDP or gross domestic product, all right, unemployment rate, inflation, interest rates, budget deficit, and sentiment. Okay, so these are the ones that I'll expect you to know for the course. Let's dive right into these. I assume that you probably are already familiar with some of these, but let's make sure that we know exactly what these are. So I'm going to do a slide on each one of these. The first one, GDP, gross domestic product. What is the definition of this? This is the market value of goods and services produced over a period of time by a country. Okay, so for us, it would be the GDP of the US. All right, and of course, strong GDP growth indicates what? Strong economy and high earnings growth potential for companies. Why? The market value of goods and services. Who are producing these goods and services? Companies inside of the United States. So when we see high GDP growth, that is the economy is expanding, that generally means that companies are doing well. Okay. In particular, a recession is defined as 2 consecutive quarters of shrinking GDP. Okay, so when that gross domestic product actually shrinks, if it does it for 2 quarters in a row, that is the typical definition of a recession. So if you ever wondered, like, you know, when they say we're in recession, what do they actually mean? What are they looking at? They're looking at GDP. And if that GDP is shrinking for 2 consecutive quarters, there you go. Okay, so that's GDP, basically what a country is producing. every year. And of course, you want that to go up. You want them to produce more. Next one, unemployment rate. This is a straightforward one. It's the ratio of the number of unemployed to the total labor force, just how many people are out of work, right? And you can think of this in different ways. It's a measure of capacity utilization of labor for the economy. You can think of labor or people as a resource that the economy can use. If it's using it efficiently, everybody's working, everybody's producing something that creates wealth for the country, right? If a lot of people are unemployed, then they're not able to use their time to produce wealth, to produce new products, okay? So, and this is sort of obvious. In general, what do you want? You want unemployment to be low, meaning everybody is working, producing something, and that creates more wealth for the country. Okay? Low unemployment means the economy is fully utilizing the labor force. All right, let's go on to the next. Inflation. What is inflation? It's the rate at which general level of prices for goods and services is rising. Okay, so inflation is basically prices going up. All right, so high inflation, that's generally bad, right? You don't want prices to be shooting up more and more because that means your money that you're spending won't go as far. You can buy less and less with that. And there are different ways that high inflation will result from different economic conditions. So here's one typical one that they look at. High inflation can indicate that an economy is overheated and demand is outstripping productive capacity. This is sort of demand side inflation. And let me explain this a little bit further. If you have a product and the supply of that product is limited, you know, maybe it's like a new iPhone or something like that, but everybody wants to buy it, very high demand, then what's going to happen? They're going to push up the price, okay? And that price going up, that's inflation. So that is sort of demand side overheating economy inflation. That would be the economy is going so well that everybody feels like they have a lot of money and they're spending a lot and they are demanding more, right? I'm going to buy new products, I'm going to buy a bunch of things, and everybody is doing that, and that demand for those products is going to push up prices, and that's sort of an overheated economy. Okay, so that's demand side inflation. You can also have supply side inflation. What is supply side? Everybody needs to buy something. Okay, maybe it's eggs these days, and what happens? You have a big reduction in the supply of eggs. Okay, then everybody is still demanding the same amount of eggs, but the supply went down. That would be inflationary as well. The price shoots up just because there's that limited supply and everybody still wants the same amount. Okay, so there are different scenarios, basically the supply side and the demand side scenario that gets you to inflation. All right. Governments and central banks, okay, if you look at like the Fed and you read into what they say they're aiming for in their Fed policy, is they actually say they're aiming for low unemployment, so they want everybody to be employed. We said that was good because then people are producing goods and services. Without high inflation, they don't want that to be overheating the economy, sort of the demand side, and pushing up prices for high inflation. So they often say their goal is to balance those two with their monetary policy. Okay. Let's move on to the next one here. Interest rates. We know what interest rates are. So interest rates are just the interest that you earn on money for, if you loan money. High interest rates reduce, this is a very finance way of putting it, high interest rates reduce the present value of future cash flows. That's sort of a little too financy for me. A more direct one is just high interest rates mean what? They mean borrowing or financing is expensive. So if interest rates are high, right, and you go out to buy something and you have to borrow money for that, you look at the interest rate, oh, I'm going to have to pay very high interest if I borrow money, oh, that's going to make it more expensive. Okay, so in general, like if you're a business and businesses borrow, how do they borrow? They issue like corporate bonds. Or if you're a government, governments borrow a ton, right? They issue like treasury securities in the US, they issue government bonds. If interest rates are very high, it's very expensive for them to borrow. Okay, so in general, like companies, what do they like? They love low interest rates, right? Because then you can borrow cheaply and you can try, new investments and stuff like that. It's not really expensive from an interest rate perspective. All right, so high interest rates in general tend to put a damper on especially corporate activity, right? So if interest rates are really high, then corporations are not going to expand as much and things like that because their borrowing costs to do that will be higher. Okay, what are some of the factors that affect interest rates? So interest rates come out of, somebody has to loan money to, say, a corporation, right? So it's on the supply side, it's the supply of funds. That's from savers or households. That's from all of us, right? At the end of the day, we're the ones that supply the money. The demand for funds from businesses, right? Like I said, businesses are big borrowers, right? They borrow a lot to go and expand their business. Also, the government, okay? So the government's net supplier demand for funds as modified by the Fed. The government borrows a ton, so they also borrow a lot. And then finally, the expected rate of inflation. We just talked about inflation. How does that get baked into interest rates? Well, if you think about it, if you're going to loan somebody money, when they pay you back plus interest, you want to at least keep up with inflation. Why? Because if you're losing to inflation, if you say the interest rate that you're getting is 3% and inflation is 4%, then when you get your money back plus interest, you can actually buy less than when you loaned that money. And of course, nobody wants that. So if you're loaning money, you want to make sure I'm at least going to be able to keep my purchasing power. Plus, normally, you want to earn some interest on top of that as well. So higher inflation usually leads to higher interest rates. All right, let's talk about another one here, budget deficit. Okay, so this goes along with the government being one of the largest borrowers. Okay, they affect interest rates a lot, and the amount that they have to borrow is affected by their deficit. So the budget deficit, what is that? Government spending in excess of government revenues. Let's put down here per year. Okay, so on a yearly basis, it's called the deficit. Overall, the amount that the government owes is called the debt. Okay, so that's the distinction between those two. So this one here, it's talking about budget deficit. That is on a per year basis, how much they have spent more than how much they're actually taking in, and that's the amount that they have to borrow on a yearly basis. All right, so large government borrowing. If there's a high deficit, the government has to borrow that money, and that crowds out private borrowing. And of course, that increases interest rates. Why? Because that's a lot of demand for money. And that demand for money, basically the price of money is reflected in interest rates. And so when there's a lot of demand for that money, especially by the government, that's going to push up interest rates. And of course, higher interest rates, businesses don't like that because that increases the cost of their borrowing. Okay. Finally, the last one here is sentiment. And what is sentiment? Sentiment is consumer sentiment, and sentiment is just whether people are optimistic or pessimistic about their future. Okay, whether they think the economy is good or bad, whether they think their job is secure or not. And this one is consumer sentiment. So they just actually what they do here is they just go out and they survey people. They just randomly select people and they ask them. Like, are you optimistic or pessimistic about your future, right? Like your own job. Are you going to get a raise? Yeah, I think I'm going to get a raise. I'm very optimistic about that. Or are you worried about getting laid off? And they just ask people, right? And people will tell them. Okay, so it's sort of their sentiment. They also ask them about the overall economy. How do you feel like the overall economy is doing? Is it doing well or is it doing not so well? Okay. And why is that important? Well, if consumers are confident, they spend more, okay? And this drives economic performance. Let's just think about that. If you're at your job and everything's going really well, you see the economy is going well, and you think, hey, I'm going to get a raise, you might go out and buy a new car, right? And so that's going to drive more economic performance. On the other hand, if you're worried about your job, they might lay me off, then what are you going to do? You're going to cut back, right? You're not going to spend as much. You're going to try to save for that rainy day in case you get laid off and you have to search for a new job. You're definitely not going to go out and buy a new car or anything like that. So you're going to cut back on your spending, right? And that's going to actually have an effect on the overall economy if a lot of people do that. So by just going out and asking people their sentiment on their own personal situation, on the economy, they can get a sense of whether people are confident and might spend more, or whether they are pessimistic and might pull back on their spending. Okay, so that's what this says here. If consumers are pessimistic, they spend less. This negatively affects business performance. Okay, so where do you find these? These are some of the main sort of headline indicators that the market definitely watches. Let me show you a good website if you're saying, hey, I'd like to track these just to try to get a sense of how the economy is going. So I'm going to show you a website right here. Let's jump over. It's called Trading Economics. Okay, Trading Economics. We can see it's sort of economics, all right? These are macroeconomic indicators, but aimed more at traders. And you look here, and there's a lot of information going on, but I'm going to scroll down. So you just scroll down a little bit. And right here, what do they have? They have different countries, okay? And we can look, and at the very top, what do they have? They've got, let's go right up here. They've got the United States, and they have essentially the indicators we just looked at. Why these are the most important ones. Okay, GDP growth. Okay, so we're up 2.3%. The interest rate, we said that's important because that's essentially the borrowing rate for both the government and companies. The inflation rate, right? Jobless. Okay. Government budget. Okay, so this is like deficit. And then they also have some others that we didn't cover here. Debt to GDP. Debt, again, is the overall amount that the government owes. We didn't talk about that. And then there's some related to trade. Okay. So this is a great place. You can see not only the United States and all of our headline economic numbers, you can also see them for other countries, China, Euro, right, Germany, Japan, India, etc. If you want to dig deeper, you can click on these, right, and it will show you, and it's going to show you some more numbers, currency, stock market, GDP growth, a bunch of other things, and you can dig into these even further. Here, I just clicked on another one, and you can get some plots of how it's been doing over time. So this is a nice website. If you like these indicators, go to tradingeconomics.com, and you can take a little bit of a deeper dive into them. Okay, let's jump back to the slides here. So I had this right down at the bottom if you're interested in this, Trading Economics. All right, last part of the section, what I'm going to talk about is some ways to take events that are going on in the world. Again, let's say we're at the end of the day, we're interested in markets and investments. And so we'd like to know how events in the world, whether they're macroeconomic events or other events that are going on in the world, might affect investments and in particular prices. So a nice way to do that is to put things in a demand and supply framework. So let's see how to do that. Okay, so a useful way to categorize events is in terms of whether they affect demand or supply, and then that'll help us think through the consequence on prices. And again, if we're an investor in general, we're interested whether the price of something is going to go up or down so that we can invest in it. So let's think about that. All right, so we define what's known as a demand shock. What is this? This is something that affects the demand for a product. Let's think about that. So this is an event that affects demands for goods and services in an economy. So an example, maybe there's an increase in government spending. Maybe there's a new bill that says they're going to spend on infrastructure, they're going to spend on, I don't know, roads or something like that. So you know there's going to be more demand for that product, right? For, say, companies that build things related to roads, for big machinery that would work on that, right? So that's the idea. You look at something happening in the economy. It doesn't have to be an economic thing. It could also be some other event. But you look at it and ask, does that affect the supply or the demand of something? Okay, so if it's a demand shock, you conclude it's going to affect the demand of something. And here, a positive shock, what does that mean? A positive shock means what? Demand goes up. So if demand goes up for something and supply stays the same, what is that going to do? That's going to push up prices, right? A lot of people wanting to buy the same thing pushes up prices. So that's associated with an increase in prices, which is inflation, right? And then inflation, we said, gets baked into interest rates. So that would likely also cause an increase in interest rates. So allowing us to first think about and classify something as whether it's on the demand side or the supply side of something allows us to then sort of logically think through how will this affect prices? How does that affect inflation? How do we expect to see that in interest rate? and that might affect our investments. So this is the demand side, right? A positive demand shock would be inflationary. A negative demand shock would be the opposite, deflationary. We can also do it on the supply side if something is a supply shock. So what would these be? An event that influences productive capacity, right? So it might be something like an oil shortage, okay? So there's an oil shortage and there's less oil, so the supply of oil went down, okay? Or a drought, right? Like bad weather hits orange crops, right, in Florida. And so they all get wiped out. And so what is it? The supply of oranges drops, okay? So that would be a negative shock. So a negative supply shock, that is associated with increases in prices, right? Because if all the oranges get wiped out, right, by like an early frost or something like that, then the supply of oranges goes down. If everybody's still demanding orange juice, then and there's less oranges, then the price is going to shoot up. So in this case, a negative supply shock is associated with increase in prices, which again is inflationary, right? And again, to the extent that inflation gets reflected in interest rates, we would also expect that to cause interest rates to potentially go up, okay? So nice framework here of taking an event in the world and trying to figure out how is that going to affect prices, and then depending on, or even interest rates, right? And then that could potentially inform your trading or your portfolio, okay? All right, couple of final things here, terminology that everybody should know if you're familiar with markets, and these are related to federal government and federal government policy. So the first is what we call fiscal policy. If somebody's talking about fiscal policy, what are they talking about? They're talking about government spending and taxing, okay? So that is what fiscal policy means. So that's tax policy and things like the deficit and the spending, what the federal government is spending on. All right, as opposed to monetary policy. If somebody says, hey, they're changing the monetary policy, or what's the monetary policy of this country, what they're talking about there is central bank, okay? So in the US, it's actions taken by the Board of Governors of the Federal Reserve. That is the Federal Reserve, or the Fed. That's our central banking system. So that's like interest rate decisions when the Fed comes out and says we're going to raise interest rates or we're going to decrease interest rates. That is classified as monetary policy. Okay, so know those distinctions there. Fiscal policy is government taxing and spending. Monetary policy is actions by the Fed, or the Federal Reserve. And then finally, you might see this terminology. If somebody refers to a policy as a supply side policy, what they're doing there is they're using the analysis on the previous slide, right? Trying to understand things in the context of demand or supply for products. And they're trying to apply basically that analysis to some policy, okay? And in particular, if they say something is a supply side policy, then that was a set of policies that was aimed at essentially inducing more supply in a product, which at the end of the day is really what you want, right? If there's more supply of goods and services, that's really what the wealth of a country is, right? Producing more output. So supply side policies, these were policies that were trying to address the productive capacity or the supply of the economy. And the goal of a supply side policy would be to induce workers or producers to produce more, or owners to produce more goods, just to make more things. Okay, so that's this terminology actually used to be more common, I don't know, maybe about 20, 30 years ago. You heard it a lot. People would say, hey, this new tax or whatever or this reduction in tax rates is a supply side policy. It's trying to induce businesses to produce more and supply more. I've heard it less recently. However, it's something still to recognize. Okay, so that was a lot of terminology, sort of macroeconomic terminology that you might run into. Let's just do a couple of quick questions here. The market value of all final goods and services produced during a given time period is called what? GDP, industrial production, capacity utilization, or factory orders. And the answer here is GDP. That's our definition of GDP, or gross domestic product. I went through 6 macroeconomic indicators. GDP was one of them. Make sure you can identify all of those. All right, here's another one. A big increase in government spending is an example of a what? And we're trying to identify, in this case, whether it is a demand shock or a supply shock, and whether it is positive or negative. So let's go through here. A positive demand shock. B, positive supply shock. C, negative demand shock. D, negative supply shock. Or E, electric shock. Okay, if you choose E, I'm going to send you to the electrical engineering department. Okay, so we know it's not E. Which of these would it be? A big increase in government spending. What kind of a shock is that? And the answer here is that would be a positive demand shock. Why is that? Because the government is spending that money on something. And so they are demanding more of something, whatever they're spending it on. So that would be a positive demand shock. And then if we think through a demand shock, a positive demand shock, what is that? That tends to be inflationary, right? And the extent to which inflation is baked into interest rates, we would expect that to potentially affect interest rates by causing interest rates to go up.